put out a report in January of this year. The oil price shock only makes it worse. And it's confusing for people because prior to the war beginning, rates were headed lower. There was growth scare beginning. Private credit was freezing. Payroll numbers were coming in bad. And then the war came and everybody focused over to war headlines. And then there was a nice rally, which in a couple podcasts prior to the bottom, I said we might go to new all-time highs in the market on any kind of relief. And we did. And the market has gone up on a very narrow participation. It's all basically AI and AI adjacent. Semiconductor stocks had a move that we saw similar to the 2000 top, 64% in 5 trading weeks, just unprecedented moves. So this is very narrow participation. It's all AI. That's the only thing that's working. The real economy, the way we measure it, has gotten worse. Housing prices finally starting to give up the ghost. We had some bad home price declines. Home builders stocks are going lower. Financial stocks are going lower. They're not participating in this rally. So once the S&P gives up the ghost, it'll become apparent to everybody. And we think that's sooner rather than later. There's a scare on the long bond right now. Everyone says it's the end for the long bond and long-term rates, but we've seen this before. The rates themselves are going to cause a growth scare, and we're still very bullish on the long bond. We like cash as the best near-term investment, dry powder for picking up bargains on the other side of this. But nothing's changed on our economic outlook. Housing's gotten worse. The consumer's gotten worse. And we're going to see corporate profits get massively squeezed from this oil price shock because they're not going to be able to pass on the cost to the consumer. So we're going to see layoffs start to accelerate throughout the year as companies cut the factors of production because of the margin squeeze. China retail sales just came in. No surprise there. It was pretty dismal. And we're very bearish on China. That continues to go the wrong way. So everything is globally and economically going south. And people keep pointing to the S&P. It's bubble talk. Everyone's talking about when does it end, not if it ends, but when. And some people are saying it's 99. We've got another year of higher stock prices. I don't think so. I think we're going to see the growth scare come and be evident by the end of Q2. And I think the Fed is not going to raise rates. I think the Fed will be cutting sometime towards the end of this year. And the oil price shock has really put the Fed in a box. They don't have the tools to deal with oil price shocks because it's cost push inflation, not demand push inflation. And demand destruction is coming. I'm just really surprised at how people are not looking forward as investors. And the new cadre of traders and investors have a 2-week outlook, and that's about it. And they chase what's working. And what's working is literally the last bastion of any kind of growth, but this growth is going to come under problems pretty soon. And it's AI and AI adjacent. So the S&P 500 is now 45% AI and AI adjacent. The Mag 7's 36%. And semiconductors are about 17, 18% of the S&P 500 index, notoriously cyclical industry, and they're 30% of the NASDAQ. So what's really driven this last move in the S&P has been a very narrow sector with giant price gains. And I've been here before. I was there in March of 2000 as a tech analyst. And what we're hearing now is the word you don't want to hear in a semiconductor cycle: double ordering. Because this is what happened during the dot-com boom. Every purchasing manager, they need these components so they can build their products. So early on, as things become tight, and AI put a massive strain on that supply side, but then the oil price shock has people worried about helium shortages, which go into the manufacturing of semiconductors. So that accelerated a lot of what we call pull forward demand, getting your supply. So each purchasing manager individually, let's say they need 1 million units. A couple quarters ago, they started hearing, well, we can only give you half of that. So they start double ordering, saying, I want 2 million, and then they get their million. That is the beginning of the end. And then when the demand destruction comes and flips, then they start canceling orders, and all these semiconductor companies are stuck with inventory. That's where we are. We're closer to the end of this than the beginning of anything. The valuations last year were silly. They got even more silly. So we're at crazy stock market valuations. And, people that I consult with from time to time, and they'll get a inheritance and they'll be like, I have $4 million. What should I do with it? Should I put it in the stock market? And I say, well, if you do now, mathematically, your return over the next 10 years is zero. So no, wait. And we are. The corporate earnings are mostly due to AI and semiconductor earnings. That's where all the revisions are coming from. Look, I was on Wall Street. What they do with forward estimates is they grow them continuously. And, second derivative shift here pretty soon. And all you need is a second derivative. One company to say there's a little weakness and the whole thing implodes. And this is not well known in the public and maybe even in investing circles, but purchasing managers are well aware of what's going on with helium. And they panicked and they bought more than they did even for AI. So I think the stock prices themselves are telling you the end is not, in semiconductors at least. Whether that causes a general market problem remains to be seen. We have no structural evidence that there's a bear market yet, and you don't crash from tops. So what I would expect to see sometime in the next 3 to 6 months is a healthy 20 to 30% pullback, scary, then a counter trend rally, the Fed starts cutting, and then if we're in a bear market, that counter trend rally will fail and then we'll go to lower lows, which I think we're almost there. I've never seen anything like this economically. The disconnect between the consumer and the stock prices has never been wider. Joe's six-pack is struggling mightily. Credit card delinquencies are rising. Auto loan delinquencies are rising. And that eventually is going to affect credit. There's already a private credit problem. Net flows in private credit are going the wrong way. For the first time, I think, in a long, long time, there's more net redemptions than there have been inflows to private credit. The marginal producer of credit the last 2 years was private credit, private equity. That's shut off. And banks had already stopped making commercial and industrial loans and consumer loans in aggregate. And if you want to look at a barometer for liquidity, keep watching Bitcoin. Bitcoin peaked in October of last year. Bitcoin is trying to rally, but it looks like it may have stalled out. So watch Bitcoin will lead any equity correction. Well, it depends on where you are in manufacturing. Manufacturing jobs in the last payroll number were negative. Secondly, I would contend that a lot of the recent uptick you've seen in manufacturing has been a lot of people pre-ordering before the price shocks really come. Housing is 20% of the U.S. economy, 25% of the consumer economy. So that is going into a decline. That's going to impact the consumption. Look, everyone thinks I'm a gloom and doomer. I believe once we get this reset, it's going to be great. I think we're setting ourselves up for a nice economy on the other side of this as we transfer wealth from boomers who don't transact to young people who form families. That'll be 2 years from now when everyone's bearish as all get out. That's when I'm going to be super bullish, a year or two, depending on how quickly asset prices. The faster we adjust, the more bullish I get sooner. If this turns into a .com, stock market 50% and a slow housing market decline, I'll wait. But I'd love to see it happen quick, rip the bit off, and then we come out the other side. We said it's going to roll over. We said that in January 2025, and we saw new tenant rents going lower, and those continue to go lower. All tenant rents are going lower. Now home prices are going lower because those all lead, new tenant rents lead. The big impact has been the closure of the border and a lot of self-deportations from illegal aliens. And, some of the the FHA under Biden were giving 100% loans to illegals to buy homes. That's gone. Yeah. So the home price declines really started in the South near the border. So a lot of these red states along the border have been seeing the brunt of it. And now we're starting to see national prices come down, like I said. And it's going to spread to the blue cities, especially if we get into a lot of tech layoffs and just general layoffs from the oil price shock. We were expecting it to happen, but the oil price shock only accelerates this, in my humble opinion. It really does. Part of the reason I don't think the AI bubble is going to continue is because there actually is a shortage of capacity to run these data centers, and there's not enough water to do it, so they're running into opposition. So I'm of the opinion CapEx is going to be scaled back as they realize they can't plug into anything. And there's somebody on X who's an analyst who's running around the country looking at all the data centers, and he said you'd be surprised at how many of them are not completed yet. So there seems to be all this future cap announcements, but then the actual going in the ground, getting it up and running is not as fast as people think. And that's the bottleneck. That's how you end up with like a ton of inventory and everything that you can't deploy it, so it's sitting in a warehouse. And you don't need to order any more NVIDIA chips. I think the constraining factor is electrons, water, and social acceptability of this. And there's going to be a lot of fights. So the other thing about AI is there's all sorts of conflicting. Is it going to really replace white-collar jobs that quick? I personally believe that's hype. I don't believe it's going to happen. Because you see these weird announcements where like Ernst & Young and other companies are teaming up with OpenAI to help implement the solutions in the corporations. So it's supposed to get rid of consulting and white collar, but you need them to install it. And then Google said they're hiring engineers to help their clients. So we're hiring people to deploy something. It sounds like it's complicated and maybe not as easy as people think to get up and running. Secondly, there's all sorts of reports that people are running through their token budgets so fast that they're just deciding that it's actually cheaper to keep humans. So there's all sorts of conflicting, stories. It's not as someone might think. So I don't know why the Anthropic CEO keeps saying white collar jobs are going to be gone in 18 months. I mean, it seems silly that A, if it's not true, and B, it's not a good sales pitch.